You look at the ticker. It's up over 16% in a single session.
Sure.
Is this a falling trend finally reversing into a strong buy?
Or a value trap?
Right, exactly. Are
Yeah.
you staring at a classic value trap waiting to catch retail traders?
I mean, it is the ultimate dilemma for anyone watching the market today, especially, in the incredibly volatile world of clean energy.
Absolutely. Well, welcome to today's deep dive. Our mission today is to dissect the dizzying volatility of Plug Power Inc.
Ticker symbol PLUG.
Ticker symbol PLUG. And we're looking at this as of right now, April 21, 2026. We are not just going to read you the numbers. We're going to unpack the underlying mechanisms behind the company's financials, tear apart their technical indicators.
And really weigh the latest analyst ratings.
Yes, exactly. To uncover what is actually happening under the hood.
Yeah.
And before we get into the weeds here, if you're tuning in on our YouTube channel, make sure to like the video, subscribe, and you absolutely must leave us a comment with your feedback. We really want to know which side of this debate you fall on.
Yeah, let us know. And just to set the ground rules right up front, everything we are discussing today is purely a natural human debate and analysis of the data. This is not financial advice.
Right.
We are just looking at the numbers, the structural context, the history to help you understand the landscape. But, any moves you make in the market are entirely your own.
Perfectly said. So rather than just stating that the stock is up, let's look at the actual mechanics of this massive sudden spike. Because right now, Plug Power is trading at $3.23.
Yep.
That is a massive 16.19% jump in just the latest trading session. But context is everything here, right? Over the last 52 weeks, this stock scraped an absolute bottom of 69 cents.
Just brutal.
Yeah, and peaked at $4.58.
Yeah.
So at $3.23, we are seeing a violent upward swing out of a really brutal trough. And the volume is what really caught my eye.
Oh, the volume is insane.
Right.
Yeah.
We are seeing 112 million shares traded today. The average daily volume is usually around 89 million.
Yeah, and that volume discrepancy is the key to the entire technical picture right now. I mean, when you see volume spike 25 million shares above the daily average alongside a 16% price increase.
Not retail.
Exactly. That is not just a bunch of retail traders opening up an app on their phones to buy a few shares. That kind of volume indicates serious institutional buying pressure. You've got Wall Street funds, algorithmic trading desks. They are moving heavy capital into this stock today.
Okay, let's unpack this because I want to make sure we understand exactly what these algorithms and institutions are reacting to. When we look at the technical analysis, the momentum has clearly shifted to short-term bullish.
Definitely.
And that's because the stock has broken above all of its critical moving averages. I mean, it blew past the 20-day average at $2.24, the 50-day average at $2.84, and crucially, the big one, the 200-day moving average at $2.44.
The 200-day. Yeah.
It's like a car that's been stalling out for miles, but suddenly it catches a gear and just blows past all the traffic, which are those moving averages. For those who might not track technicals daily, why is crossing that 200-day average such a massive trigger for institutional money?
Well, because the 200-day moving average acts as this psychological and mathematical battleground. It basically represents the long-term trend of the stock over roughly a full year of trading days.
Right.
So when a stock is trapped below it, institutions view it as fundamentally broken, or at least in a persistent downtrend. It acts as a heavy ceiling. Every time the price creeps up, sellers push it back down.
But today it broke through.
Right. When a stock manages to smash through that ceiling with the kind of volume we saw today, it signals to algorithmic trading bots and massive funds that the macro trend has officially reversed. The ceiling basically becomes the new floor.
Right, and it's not just the moving averages flashing green either. I was looking at the momentum oscillators, specifically the RSI and the MACD. And I want to break down what these actually mean rather than just throwing financial acronyms around.
Good idea.
So the RSI, or Relative Strength Index, measures the speed and change of price movements on a scale of 0 to 100. Over 70 means the stock is overbought and exhausted, and under 30 means it's oversold. Right now, Plug Power's RSI is sitting between 54.7 and 61.8.
Which is pretty healthy.
Yeah, so it's neutral to slightly overbought, but it has plenty of runway left before it hits that danger zone.
Exactly. It has room to run.
Right. And then there's the MACD, the moving average convergence divergence. This basically looks at the relationship between a short-term and a long-term moving average to tell us if a trend is accelerating or slowing down. Right now, it's positive at 0.03. But, and here's my pushback, with a heavy resistance level looming right above us at $3.36 and that 52-week high all the way up at $4.58.
Yeah, the big question.
Is this momentum real, sustainable strength, or is it just a short-term sugar rush before an inevitable crash? Because the chart looks great, but if institutions are buying, I have to wonder if they've actually looked at the income statement.
That is the perfect pivot, honestly, because the disparity between the technical chart and the fundamental reality is, well, it's jarring.
Here's where it gets really interesting, because when you open the financial books, the reality check is severe. Let's look at the TTM, the trailing 12 months, which just means the data from the past 4 consecutive quarters. Plug Power reports a total trailing revenue of $709.92 million.
Which sounds good.
Right. On the surface, bringing in over $700 million sounds like a robust business. But then you look at the net loss, and it is a staggering negative $1.63 billion.
Just massive.
That translates to an EPS, or earnings per share, of negative $1.42. For every share of this company that exists, they lost $1.42.
It is a massive, almost unprecedented disconnect between the top line and the bottom line for a company of this scale.
I genuinely need to understand the mechanics of this burn. I mean, the balance sheet shows $378.74 million in cash against $997.17 million in total debt.
Almost $1 billion in debt.
Right. Furthermore, their operating cash flow, the actual cash generated by their normal business operations, is negative $351.78 million. They're hemorrhaging money. How on earth does a company survive when it burns through $500 million in cash and posts a $1.6 billion net loss while sitting on nearly $1 billion in debt? Why is producing green hydrogen so punishingly expensive?
Well, to understand that, you have to understand the physical reality of green hydrogen.
Okay.
To make it, you use a machine called an electrolyzer, which uses massive amounts of electricity to split water into hydrogen and oxygen. If that electricity isn't incredibly cheap, and if your infrastructure to store and transport that highly volatile gas isn't perfectly optimized, you lose money on every single molecule you produce.
Wow.
Plug Power isn't just making a software app, They are trying to build a nationwide physical energy infrastructure from scratch. They have to build the plants, manufacture the electrolyzers, secure the renewable energy contracts, and build the cryogenic logistics networks. That requires billions in upfront capital expenditure before you see a dime of real profit.
Okay, so the capital intensity is off the charts, but a company can't survive indefinitely if it costs them $2 to make a product they sell for $1.
No, they can't. But what's fascinating here is the trajectory of those unit economics rather than just the raw current numbers. Wall Street rarely trades on what a company's doing today. They trade on the derivative, the rate of change.
The forward outlook.
Exactly.
Right.
If you look at Plug Power's gross margins, they used to be an absolutely abysmal negative 132.3% year over year.
Meaning for every $100 they made in revenue, it cost them over $232 just to produce the goods.
Precisely. It was a structural nightmare. But recently, those gross margins have improved dramatically to negative 37.56%.
That is a massive jump, yeah. But we are still talking about deeply negative margins.
We are, but it shows the bleeding is slowing down. And that improvement is directly tied to what Plug Power Management is calling Project Quantum Leap.
Project Quantum Leap.
Yeah, it's not just a corporate buzzword. It's an aggressive internal initiative to vertically integrate their supply chain and slash the cost of manufacturing those electrolyzers. The stated goal of Project Quantum Leap is to reach positive adjusted EBITDA by the fourth quarter of 2026.
Let me quickly translate EBITDA for the listeners. That's earnings before interest, taxes, depreciation, and amortization. Basically, it's a way to measure a company's core operational profitability by stripping out the heavy financial and accounting costs, like the interest on that billion-dollar debt.
Right.
If they can hit positive adjusted EBITDA, it proves their actual day-to-day operation of making and selling hydrogen is finally viable.
Exactly. They're basically trying to prove they can scale without going bankrupt in the process.
But banking on a quantum leap sounds like a high-stakes gamble. If the financials are this bleeding edge and their survival hinges on a plan that is still quarters away, who is actually willing to bet their money on it? Let's talk about the analyst ratings and the insider trading, because I dug into the SEC filings, and the narrative there is just as conflicted as the balance sheet.
Oh, absolutely. Analyst sentiment right now paints a picture of extreme caution. If you look at the consensus among the 16 to 30 major analysts covering the stock, the overwhelming verdict is a resounding hold.
A hold.
Yeah, across the various platforms, we are looking at 12 holds, 5 buys, and 3 sells. But the critical and frankly negative signal here is their intrinsic valuation. The average Wall Street price target for Plug Power right now sits somewhere between $2.83 and $3.03.
Wait, which means the current price of $3.23 has actually completely overshot the average Wall Street expectation.
It has.
Even with price targets ranging wildly from $9 all the way down to 50 cents, the aggregate consensus says this stock is currently trading at a premium to its actual value. But what I found even more compelling is what the executives inside the building are doing.
Oh, the insider trading data is wildly contradictory, isn't it?
It really is. It's a stark contrast in the boardroom. On one hand, you have the chief financial officer, Paul Middleton. Over the last 2 years, he has systematically purchased $920,000 worth of Plug Power shares.
Wow.
Right. The CFO is the person who sees the raw, unfiltered numbers before anyone else. When the CFO drops nearly $1 million of his own cash into the stock, it historically signals immense confidence that the internal metrics like Project Quantum Leap are actually working.
Sure, it's a huge bullish signal, but then you have to look at the other side of the executive table.
Yeah.
Officer Benjamin Haycraft sold off 40,000 shares back in January 2026, and the key detail is the price he sold those shares at roughly $2.17 apiece.
So he locked in his gains at $2.
Yep. This raises an important question. When your current price of $3.23 exceeds the consensus target of Wall Street, and your own officers are locking in gains and fleeing at $2, does that signal a fundamentally overvalued stock that is destined to revert to the mean? Or is Wall Street and even some of the company's own officers just totally underestimating the scale of the impending green energy revolution?
So what does this all mean? This brings us to the ultimate showdown of this deep dive. Is Plug Power an undervalued innovator that is finally turning the corner? Or is this a mirage acting as a classic retail value trap? Let's lay out both sides and let me take the gloves off and start with the bear case.
Let's do it.
Because to me, the downside risks here are immense, and retail traders are notoriously bad at spotting the trap.
Let's hear the bear thesis.
The absolute biggest red flag for the bears is the relentless history of share dilution. Plug Power currently has 1.39 billion shares outstanding.
That is a staggering amount of shares.
It is. We talked about how capital-intensive hydrogen is and how they burned through $1.6 billion. To fund that burn, they couldn't just take out infinite bank loans, so they issued more and more stock to the public.
Yeah.
It's essentially like printing your own corporate currency.
Right.
But the more shares you print to pay your bills, the less each individual share is worth to the person holding it. The size of the pizza doesn't change, but you keep slicing it into thinner and thinner pieces. It is an invisible tax on the retail investor.
And that dilution is exactly why long-term holders have been crushed over the last 3 years.
Exactly. Add to that the massive debt, and you start to see why discounted cash flow models are so punishing. A DCF model is a valuation method where analysts forecast all the future cash a company will ever make and then discount it back to its present value today. Because Plug Power's cash flow is negative $350 million, some DCF models claim the actual intrinsic value of this company is just $1.24 per share.
$1.24. Ouch.
Right. If that math holds up, the stock is currently up to 55% overvalued. And this is the trap. Retail traders see a 16% single-day spike, they see the institutional volume, and they chase the momentum thinking it's going to the moon. But they get crushed weeks later because the company eventually has to issue more shares just to keep the lights on.
That is a highly compelling, mathematically sound bear case.
Yeah.
Honestly. But it assumes the future looks exactly like the past. And the bulls argue that the paradigm is fundamentally shifting.
Okay, let's hear the bull case then.
The core of the best case recovery scenario is the sheer magnitude of Plug Power's early mover advantage. Yes, building out hydrogen infrastructure has nearly bankrupted them, but now that the infrastructure is partially in place, the barrier to entry for any new competitor is almost insurmountable. They have built the moat.
But a moat doesn't matter if the castle is burning down from the inside. I mean, how do they fix the unit economics?
They fix it through government intervention, specifically the 45V tax credits. This is a crucial mechanism that the bears often discount.
The 45V.
Right. The 45V credit is a clean hydrogen production subsidy from the federal government. It is designed to pay companies a sliding scale credit up to $3 per kilogram for the clean hydrogen they produce.
Wait, let me stop you there because that is massive. You're saying if it costs them $5 to make a kilogram of hydrogen, and they can only sell it in the market for $4, they usually lose a dollar.
Exactly.
But with this 45V tax credit, the government hands them $3 per kilogram, instantly turning a losing transaction into a $2 profit margin.
Exactly. It fundamentally alters the unit economics from the ground up. If Plug Power can scale production and meet the strict emissions criteria for those credits, their gross margins won't just slowly improve to zero, they could violently swing into positive territory. Because of that specific legislative catalyst, other valuation models claim the fair value of the stock is actually $2.74. While that's still slightly lower than today's $3.23, it suggests that if momentum holds and they execute their internal plans, the underlying business is far stronger than the 69-cent lows we saw earlier this year. In a blue sky scenario where they capture the global market, it might actually be undervalued.
So it all comes down to execution. The ideas are great, but can they deliver? Looking at the calendar, there are 3 major impending catalysts that are going to either validate the bulls or vindicate the bears.
Yep, it's make or break.
First, we have Q1 earnings coming up on May 11th, 2026. That will be the ultimate reality check. Wall Street isn't going to care about long-term visions. They want to see if Project Quantum Leap actually improved those margins quarter over quarter.
Right.
Second, the market is desperately watching for new large-scale electrolyzer contracts. They need to prove major industrial players are actually buying their technology at scale.
And then there's the white whale, the catalyst that dwarfs all the others.
The $1.66 billion loan from the Department of Energy.
This DOE loan is the ultimate lifeline. We mentioned the $1 billion in debt and the rapidly depleting cash reserves. Securing this $1.66 billion is quite literally the bridge bulk. Plug Power needs to survive long enough to reach their Q4 2026 profitability targets.
Yeah.
But to get that money, they have to prove commercial viability and meet incredibly strict regulatory criteria. It is a grueling process.
It's like buying a lottery ticket that pays out in a monopoly on pure hydrogen fuel versus buying a leaky bucket that is being held together by government red tape. If they can navigate the regulatory hoops and the DOE loan comes through, the lottery ticket pays off, the balance sheet is saved, and the shorts get squeezed.
Yep.
If it doesn't, the bucket falls apart and the debt crushes them.
That's a great way to put it. And if we connect this to the bigger picture, your outlook on the stock really depends on your time horizon.
How so?
Well, in the short term, meaning the next few days to weeks, this bullish momentum could absolutely carry the stock higher. The institutional volume is there, the technicals have crossed over, and if it holds that critical support level at $2.79, it will likely test the heavy resistance at $3.36.
But if it drops below $2.79,
then the short-term technical thesis falls apart, and the algorithms will likely turn into sellers. But in the medium to long term, none of the technicals matter. Everything hinges entirely on the fundamental hydrogen economy materializing. Plug Power must hit positive EBITDA by the end of the year, and they must close that DOE loan. If they don't, the debt load simply becomes mathematically unmanageable.
So what does this all mean? We see that Plug Power has a massive first-mover advantage, heavily shorted technicals ripe for a squeeze and improving margins. But they are desperately waiting on this $1.66 billion DOE loan to bridge the gap to their 2026 targets. It makes you realize how fragile this entire ecosystem really is.
It really is.
It leaves you with a deeply unsettling question. We know they are waiting on that money. But what happens to Plug Power, and the entire green hydrogen industry for that matter, if the political winds shift and the government simply decides to turn off that funding tap?
Yeah, that's the billion-dollar question.
That is going to do it for today's deep dive. Thank you so much for joining us. Remember to hit subscribe on our YouTube channel. Drop your take on the Plug Power bull versus bear debate in the comments below, and we will see you next time.